focus now on global cues. Donald Trump has sent the markets on a roller coaster ride. In his transition speech as the next president of the United States of America, Trump escalated the attack on outsourcing, immigration policy, and this time targeted pharmaceutical companies exporting to the U.S. as well. The growing fear of protectionism under Trump administration has added to the global uncertainty to make sense of what his policies might look like and what it would mean for companies in India, whether IT or pharmaceuticals. To decode it and discuss it in detail, joining us on the show is Mr. Seth Freeman. He's CEO at EM Capital Management. Good morning, Seth. Always a pleasure to speak with you. And on an important day like this, the next 9 or 10 days, we'll see a smooth transition from Obama to Trump. From the text of the speech and the summary of the speech yesterday, what is your key takeaway?
Well, I think the consensus is that it was pretty short on policy per se. And this issue of establishing a bidding process for the government to buy pharmaceuticals roiled the market. This is the week of the big JP Morgan healthcare conference and biotech summit in San Francisco that I attended. And there were thousands of attendees whose livelihoods depend on the healthy pharmaceutical business. And we saw the market drop around 4% for a while with a slight recovery. And I guess some of that's reflected also in Japan today. So this is kind of big news.
Right. Seth, not only in Japan, even in fact, a lot of big Indian companies have a material exposure in terms of the US geography, in terms of their revenue realizations. And we are seeing that in the stock moves early morning post-opening as well, and some of the larger weightage counters, in fact. Can you take us through how this changes or alters things for the negative towards industries that have, at least till now, a trade arbitrage in terms of labor?
Yeah, well, you know, in terms of the Indian pharmaceutical companies, so much of what's exported here are generics, and they are already very, very low cost here in the United States. I think it might be, if there's, I haven't really been able to check on those yet here about India today, but I think some kind of reconciliation against, frankly, a strengthening dollar may help offset any kinds of reduced revenues to Indian firms. I really don't see an issue long-term, mid to long-term with Indian pharmaceutical firms. And in terms of the CRAMS firms, ironically, because of the need to produce drugs, especially breakthrough drugs, orphan drugs, faster, cheaper, and so forth, it might actually be very positive for the Indian CRAMS businesses, even though, of course, that's another form of outsourcing.
Seth, you spoke about the dollar. I mean, speak to us also about what the impact of this quote-unquote corporate sales tax could be, because understandably and logically so, the dollar would have to adjust, right? And I mean, to that quantum. And secondly, what about retaliatory, heavier weightage trade partners, say, for instance, China? What if there is some conscious competitive devaluation further in terms of the yuan? Will that strike off a cascading effect in the emerging market pack? Would it make matters worse in terms of trade?
I don't know that relative to India, because of its relatively low level of exports to the United States, if a weaker RMB would necessarily trigger that kind of impact. I just think in general, we're going to have higher interest rates, a higher rate of inflation here in the US, and continued pressure in India, frankly, to reduce interest rates, like you're starting to see the banks already last week. So I think those kinds of opposite pulls within the domestic economies can affect currencies.
And speaking about the currency, Seth, IT earnings start off in India. The larger IT companies start to report. The only tailwind this quarter has been a depreciating currency, which is good for these guys. Probably, more of that is likely to come because yields in India have really cooled off from the top. And as you said, rates are on their downward trend and on a rate cut mode as of now here. We've seen a lot of capital flight or redemptions in terms of fixed income. And also in terms of equities, the outflow has been humongous in the month of November, even in the month of December. Is that likely to exacerbate, especially in context of the fact that the spread between the US 10-year and the Indian 10-year has gone down very sharply by 200 basis points, now at close to 400, and this compares with a very recent number of 600 basis points just a few months back?
Yes, I think you're going to continue to see a relatively high level of redemptions, and it's going to be driven partly by what I'm observing is a positive kind of sentiment impact here in the United States in terms of the markets. And what's going to help stabilize it, as I've said before, is the fact that so much investment now is based on index investing, and in terms of global indices, at least, the allocation to India will not, I don't expect that to diminish. And perhaps, frankly, because of relations issues with China and the relatively slower growth in China, maybe we'll see in 2017, 2018, larger global allocations to India. I would just be cautious, though, until we really see what Q4 earnings reports look like. I think that's going to really impact the way investors, particularly U.S. investors, make their allocations.
Right. Seth, take us through this as well. And this is in terms of the long-term borrowing costs of the U.S. government. In the near term, the rate increases are likely to have a smaller impact on the borrowing costs. But as the inflation rate increases and as the Fed continues to hike incrementally, there is likely to be a bigger impact on the interest cost as far as the U.S. government is concerned. Relatively short-term maturities of the U.S. Treasury, possibly that's also one factor. But the net interest expense, and this is an estimate, is likely to rise to almost 12.7 to 13% of the total spending in the fiscal in the year 2025. This is a projection. And this level was last seen in the early 90s. And this compares with the 6.6% in fiscal 2016. This is also in line with the Congressional Budget Office, their estimates.
Yeah, I think we have a very almost predictable kind of cycle, frankly. We have a pretty much an 8 to 11 year cycle. I can remember buying a house in 1989, I think it was. And I think our mortgage rate in the order of 14 or 15% compared to close to or below 4% over the last couple of years. So it's not unusual. We have these cycles. If we have the level of infrastructure spending that Trump policy indicates, without the considerable level of economic growth at the same time, we're definitely going to see higher rates, putting pressure not only on the government, but frankly on consumers. And our economy is so dependent on consumption that higher interest rates can reverberate through the entire economy.
Right. Seth, there was no mention of a concrete fiscal plan or fiscal spends in yesterday's speech. Does that bother you or not? And secondly, also tell us that, I mean, how much can a fiscal stimulus do in an environment of full employment already, which the United States is almost, at least academically, achieving? What's your view on this?
Well, that is a question going around the press and around economists in terms of the timing of the stimulus. Well, I guess in theory, it will create a wage inflation at the least. There are still many relatively underemployed workers. Many workers who return to work have jobs that pay less than they had before the recession. And so maybe we'll see a move up in terms of some of these people returning back to the level of wages that they had in the early 2000s. But in general, we have a real infrastructure problem here because a lot of the infrastructure is truly 30, 40, 50 years old. And I can tell you we've had enormous rains here over the last few days in the Bay Area. And in the adjacent town, there's a major sinkhole that's occurred because of storm drains that have collapsed. And we actually had the same thing here in our town. And so we actually have a lot of bridges and highways and so forth that have not been replaced in decades. So I think that's partly what Trump's talking about.
An interesting micro perspective that Seth, you gave us right now. Thanks for that. But let's also speak about the kind of fund outflows or the withdrawals you were talking about from the emerging market pack, specifically India as well. We've seen the Dow almost attaining life high levels, obviously until the correction came in yesterday, but that's a near-term blip, I mean, an anomaly. But overall, we've seen valuations really soar through the roof. Do you think that there's no end to redemption from emerging markets unless and until we see those valuations cooling off, some steam, which it is not showing signs of, at least till now, or also yields cool off, because fixed income has to become a little unattractive? Both are not happening, right?
Yeah, I just think there's going to be redemptions, but there's also some recent studies. I think even the Wall Street Journal on the weekend came out and basically said that the long-term returns from emerging markets have beat every other market. It was very bullish on emerging markets. And the real issue is, unfortunately, individual investors in particular like to buy high and sell low. And some institutional investors who are under or fund investors who are and portfolio managers who are scrutinized on a quarter-to-quarter and year-to-year return performance, make poorly timed decisions. And I'm like a broken record when it comes to long-term investing in emerging markets. And again, on the other hand, I'd like to comment a little bit about this situation with India and GAR and taxes, because one of the situations is that we do not have in our tax treaty with India, the U.S. tax treaty with India, we do not have an explicit credit for capital gains tax paid in India. And now with the new treaty in Singapore and the previous changes in Mauritius, U.S. investors who take short-term gains in India will be paying tax twice, tax in India and again tax in the United States. And the tax rate for short-term tax on, at least for individuals, which affects most partnerships, is at the rate, and income taxes are as high as 35% at the federal level. So that is going to really hurt the attractiveness of India unless that treaty can be amended.